There absolutely will be. So, welcome everybody. As we always start off with, I would like to thank you for coming out today, Friday at 12 p.m. We know it's right in the smack dab middle of your day, but we greatly appreciate your time. We greatly appreciate your attention. And today, we're going to be going into Trading Psychology Part 3. And, we've touched on a lot of trading psychology, and we could continue to do so for, probably countless hours. Trading psychology is an incredibly deep topic. But we're going to highlight some major points today that I have personally found to be working out very well for myself recently. And to kind of give you a little bit of background, these tips come from my personal trading psychologist coach. His name is Stephen Goldstein. He's a little bit well known in the Twitter sphere if you're on FinTwit. But these concepts come from him, so I do need to give him a shout out. And some very interesting stuff that we've been going over recently, and I wanted to pretty much relay to you guys here.
Yeah, and before we get started, a lot of the stuff that we're going to be going over today is really, in a sense, a way for you to reflect as a trader, to understand what you're doing and to know what kind of trader you are, right? Understanding the trading process and how important all these steps in the road are of, actually executing a trade and knowing how you're doing it. So, I'm excited to get started.
Yeah, and this is stuff, Austin, I don't even think you've really heard about before, right?
No, yeah, this is very new to me. Yeah.
Cool. So, our table of contents for today's call will be 1, the trader process cycle, the 2 trading approaches model, and the Kaizen mentality will be what we finish up with. So, to start off, we're going to be going into the trader process cycle. The trader process cycle is segmented into 5 different areas, or 5 different parts. The main idea of the trader process cycle is to provide a mental framework for everyone to use when going about your trading. This really takes you from, step A all the way to Z in terms of a trading framework. So this framework allows you to remain stable and make more accurate and rational trading decisions throughout your day. In other words, if you miss one part of the cycle, you may be opening yourself up to unnecessary mistakes or issues. And we'll go into those a little bit deeper when we go through the cycle.
Yeah, and this is my favorites, right? Starting off part 1. And this is something I relate to big time, and that is sensing and scanning the market, right? Understanding market context, understanding what kind of environment you're in. This is something you will experience if you take time away from the charts, right? It's very important to take a step away from anything you're doing, because when you come back, you'll be able to, view it in a new light through a different lens, a very refreshed lens rather than a stale one if you're staring at something for too long, right? These things could be as broad and as simple as recognizing, are we trending up? Are we trending down? Right? As Logan put, did Ukraine just get involved, or what is oil doing, right? Understanding and recognizing these very broad things that are very important to market context that may get, be overseen if you're just, looking at the computer all day, right? So sensing and scanning, being able to take a step away from the computer, looking back at it, right? Coming back with a refreshed lens and just knowing your environment is extremely, extremely important before making any trading decisions.
Absolutely. And, this is something that you may even find that overlays into other areas of your trading. Like, for example, if I have the same lines on my chart, referencing technical analysis, that may impose a bias, because let's say we have a resistance line that I'm keeping an eye on. Let's say if I remove that, I take a step back, I may be able to identify another level or another horizontal support or resistance zone, whatever it may be, that I didn't acknowledge before because I was already too focused on one area. So, the example that Stephen used when we were going over this in our session was, let's say you went to jail for a year and you were completely removed from everything the market was going about. Part number 1, sensing and scanning, is when you come back and you're finally in it again. You have a completely blank slate. You need to revisit all of the topics. What's happened in that year since you were gone? In this, it may just be what happened since last night when the market closed. But yeah.
I love that. That's such a good one. I mean, can you imagine disappearing from the markets for a year, not knowing what's going on, and you come back and everything is just drastically different, right? That's a really good mind game there.
Yeah.
Or exercise, I should say.
Yeah. So moving into part 2, this is the second part of the trader process cycle, awareness of a need. And this is the part in the process where you're rationalizing on an entry based on whatever criteria you decide to use. So based on whatever, trade setup criteria you're using. You are caught up with current market movements at this point and aware of what's going on because you just went through part 1. So part 2 could look like doing technical analysis, looking where your stops would be placed, take profit levels, etc., or completely different based on fundamental analysis. This is dependent on your system, on exactly the way you'll go about this, obviously, because everyone's entry parameters are different. But this is the part where you've moved on, you've already scanned the market, and now you're rationalizing a trade entry.
Great. So we have part 1 and part 2 so far, right? So we're scanning and sensing what's going on in the market, and then you're finding a awareness of a need, right? You're finding an opportunity. You're looking for an opportunity with your trading strategy or your analysis that you do, whether that be fundamental or technical. So
yes,
1 and 2, we're right on our way to the next part, which is action, right? And this is, I'm very happy, Logan, in the beginning of this slide, you put that this is the part that most inexperienced traders will jump immediately into, right? If you are new to trading, you're inexperienced, the first thing you want to do is you want to go ahead and get in a trade. Oftentimes, people will come into a trade, and they'll execute a trade and take action on it without doing the other things that we mentioned earlier, without sensing and scanning the market and looking for an ideal opportunity, right? Having a plan, having a strategy going into your trade. So the action is very, very important. It is like the guts of the entire, the entire trade itself, right? Taking action and executing. Logan, I don't know if you wanted to touch on the stuff down below.
Yeah, absolutely.
Yeah.
This part will again be dependent on your trading system, but you will be using your intraday or intra-trade management tools here. And where most people will get tripped up as they skipped over the last 2 crucial parts, which Austin just went over. Those last 2 parts provide the essential context you need in order to act rationally during part 3. Part 3, again, being action, and this is where your trade entry and trade exit will take place. This is the trade, right?
It's the guts.
Yeah. And then right after part 3 brings us into part 4, which is the need being fulfilled, right? This is the shortest part of the process cycle. At this point, you are already out of your trade and you're reflecting on the trade. Ideally, this is where you're reflecting on what you could have done better or where mistakes were made in that trade, right? This is also could be viewed as the closure for that last trade that was made. Again, this process cycle is for each individual trade. And that brings us into part 5.
Yep, part 5, perhaps one of the most important. These are all very, very important, but I would say part 3, maybe part 1, part 3, and part 5, in my opinion, might be the most important. I don't know, it's subjective, but letting go, right? This part is extremely important when trading. Whether you lose or you win, you have to be able to move on and look for the next opportunity with a clear mindset, right? I always say, it's like, we see a lot of people, right? We're in a community in OBR. We see many, many people take trades. We see the emotions and the reactions of wins and losses all over the place. When people lose, it'll affect their future performance, and when they win, it'll even affect their future performance. But you cannot let that happen, right? You need to be able to let go of your previous actions, and you need to be able to reset and look for the next ideal opportunity. It's just like baseball, guys, right? If you go ahead and strike out your first at-bat, you have 3 more at-bats later in that game, hopefully, if you play the whole game. And if you let that one at-bat in the beginning get a hold of you and take advantage of you, your future performance is going to be lousy, right? It's going to get to your head, right? So you need to be able to be mentally strong in that aspect of letting go to both losing and winning trades and resetting and really, starting this whole entire process over again, right? That's why it's called the trading process. Start from stage 1.
I love that. And, that baseball analogy is something that we use actually quite a bit, but it rings so true, right? Focusing on the next at-bat. But yeah, this part is actually, in my opinion, the most important part. And again, it's going to differ based on what you need in your current, your stage of your trading journey. But letting go has definitely been a huge influential part of my trading journey recently. Just because, I realize many traders will, especially on a losing trade, allow biases to impact their decisions going into the next trade. And by skipping the moving on part, you then open yourself up to forced trades, cocky trades, revenge trades, risking more than you should when you try to get back those prior losses, right? This is something Austin and I also referred to in part 1 as operating out of a scarcity mindset. But in reality, you just haven't moved on from the last trade, right? Which I guess in of itself is scarcity, right? Because you're saying that last trade has influence over your next trade.
Right, and it all comes back to the beginning, right, of like kind of having a strategy and having a plan. Not one trade should not make or break you.
Never.
Okay, and because of that reason, you should have the ability to let go. Okay, if one trade is making you or breaking you, right? If you take one trade and your account portfolio is up like 300%, like that's great, but that is a horrible trade, in my opinion, right? Because you should never be risking that much of your account, because if that trade went the other way, you would be in a world of despair, right? So though it went your way that time and maybe the trade setup was good, you know, one trade should never make or break you, and you should have the ability to let go.
Yes.
Okay? If you don't have the ability to do that, your strategy and your plan of executing the trade and how you're going about it is a little flawed. Okay, so
yeah,
very important that letting go is, you know, available in your setting, your trading environment.
I really want to say it again though that I think that this is essential. Next time that you are encountering a losing trade and you feel your emotions coming up, which is something that everybody should be aware of, right? Because we know that we can't stop emotions, but we know that we can identify them and then decide how we're going to act based on those, right? So next time you identify emotions rising up, take a step back, get off the desk if you need to, right? Austin and I all very often talk about going for a walk, just getting away so you can think clearly about what's going on. So do that. Take a step back and move on before you go into your next trade.
There are many times where a trade won't go my way, and then I'll immediately find myself, you know, scanning the market very, very aggressively, going through my watch list, looking at every single equity I could possibly think of to try to find an opportunity. The moment I realize what I'm doing, I'm like, okay, I need to get up and step away from the computer, right? And that probably saved me a lot of money in the past. So I'm thankful for that, having that mindset.
Absolutely. So next time you guys are in your trading day, I want you to remember this part. Next time you lose a trade,
remember all 5 parts.
Absolutely, absolutely.
And we're going to have a review here in just a second.
We will.
I believe this is the next slide.
Yeah, it is. Just remember to move on, either from a winner or from a loser. Nothing like, you know, we also say that you shouldn't get over exhilarated about winners, right? So this ties back into that as well.
And that goes back, right? No, not one trade should make or break you. You should not be over, like, you know, euphoric. You should not be super euphoric over one trade, right? Unless it's like the trade of a lifetime. But yeah. Oh.
I got him.
Thank you. Very quick, very, very fast, efficient.
So, yes, now it brings us into the overall trader process cycle, just to recap again. So, the first stage is sensing and scanning, right? This is our left area. You guys can see my mouse, correct?
Yes.
Awesome, yeah. So we move from sensing and scanning, that first initial part, to awareness of a need. That's when you're sense-making and planning for action. Identifying your trade setup, planning your stop loss, planning your take profit. Then we move into action. That's your trade entry and your trade exit. This is, as Austin says, the meat. Then you move into the need fulfilled when you get out of that trade, closure from that trade, then letting go, moving on. And as you can see, the process cycle does not stop there. It is a cycle, so it keeps on going. This happens for every single trade. And something that I want to highlight is, if you've ever heard about a trader going on tilt, I'm pretty sure most people have heard about that. That's essentially when somebody is skipping these 4 other steps and they are stuck in the action. They are going from action, trade entry, trade exit, right back up to action, trade entry, trade exit. That's trading on tilt. So when you keep this whole process cycle in mind, it really does add a new level of stability to your trading, because you know exactly what you should be doing mentally before you go into your next trade to make sure you're working at the most optimal way. So,
yeah, and I want to say it's really important that you guys absorb this information, because if you're sitting in this live call right now, taking the time out of your Saturday to listen to us explain this stuff to you, but you're not, you know, you have to make sure that you're actually going to make the attempt to go implement it, right? Because it all starts with you, right? You can come to these educational talks, you can hear us talk about whatever, you can hear us talk about psychology, technical analysis, but it's what you do with this information and how you apply it to your own trading strategy. That's when you're actually going to see the benefits from this, right? So just listening is good, but acting upon these things, actually implementing them into your trading strategy is going to go much, much farther than you could ever even imagine. So I just want to make sure that people understand.
Absolutely. And, you know, I really can't even put a dollar amount on how much money this has helped me make. And I know that it will continue to help me make more money in the future.
Absolutely.
Yes. So moving into our next one.
Yeah, if you want to
Sure.
this one as well.
Sure. So we're moving into our next part of the slideshow here. We're moving out of the trader process cycle into the 2 trading approaches. And I'm actually really excited to go over this one today because I think it will help shed a lot of light on a lot of misconceptions held by many traders, some in here. So a quote that I took here was, each approach requires a nuanced mindset, set of behaviors, and specific risk practices conducive to that required to succeed with each approach. Each approach produces a different psychological challenge. Understanding these and shaping a philosophy which is congruent to the I'm sorry, guys. Psychological needs of each style will be vital in driving success and remaining resilient to setbacks. Knowing and understanding your approach and working in ways which are aligned to its needs are fundamental to success with whichever approach is used. This is a whole tongue twister. The following pages describes, explores, compares, and contrasts the two approaches side by side. So breaking this down, right? So there's two trading approaches that we're going to go over. And I want to highlight before we go into this that neither approach is right nor wrong. This is overall going to be fitting to your personality as an individual. So I get a lot of value from finding where I fall into these approaches, and by doing so, you can follow the best practices that each approach inherently will work better with, and which practices to avoid.
Yeah, and we're going to be getting into the two approaches right now, which I think are very interesting. We'll go to the next slide. And this is the player. Oh, go ahead, Logan.
No, I was just going to say, the really nice thing about this is I know we have a lot of degens in here, so we're going to use the blackjack metaphor.
Yeah, absolutely. So, guys, this is the player approach, and I'm just going to say right now, there's two approaches. Did you say the two names in the last
Not yet.
slide? I completely forgot. The player approach and the house approach, okay? Right now, we're going over the player approach, and you'll see, though they are different, Logan is right. There's not one that's wrong or correct, right? They're just two different styles, two different ways of going about trading the markets, right? So the player approach style is typically associated with a few large or very large wins amongst very many small or break-even trades. So, for example, a player approach would be somebody who has like a very, very tight stop loss, right? So, like, they're going to lose often. Those losses are going to be at like 1%, 5%, 10%. But once they really are able to, snipe that bottom and they don't get stopped out, those trades will run very, very hard, right? So they don't really need to win often to be successful in the market. They just have to win a couple, really, really good ones, and they'll end up finding their way in profits, right? And you can see a few examples down below: intraday swing trading, event-driven strategies, sniping strategies, aka like sniping the bottom or sniping the top, right? So momentum trading. Logan, I don't know if you want to touch on that at all, but I feel as though there are a lot of traders like this here in OBR, both with the player and house approach. So
for sure. And if you guys are familiar with the turtle trading approach, this is essentially what this is. But you touched on everything else. So if you want, Austin, you can just continue with the player approach, and then I'll do the house.
Sure, right. And these are a few more characteristics of a player approach, right? So stop or max risk with predefined capital. Max potential loss is defined in each measure. Everybody, in my opinion, should have that. Whether your house or player approach, having a clearly defined stop loss, cutting losses quickly, as we said, right? When you're down 1, 5, 10%, right? You're out of the trade very, very quick. You take a lot of small L's. Sizing is typically a function of capital size willing to be risked on the trade. I'm not sure, Logan, do you want to talk about that one?
Sizing?
Yeah,
so we talk about this actually quite a bit, and I talk about it quite a bit as well in terms of when I'm knowing I need to scale into a position. We talked about it before in our bi-weekly calls about grading setups and allocating different amounts of capital based on the grade that you're giving that setup. And we obviously talked about how that can be on the A to F scale, on a 1 to 10 scale, whatever it may be. So in this example, it's just saying that sizing is typically a function of capital size willing to be risked on the trade. So if you have a high confidence trade, like we saw on Apple this week on Wednesday, that is an example of a trade that I'd be willing to risk much more capital on than on, just a regular trade that I spot any other day.
Right. And, in my opinion, I think these are some things that should be acknowledged by both sides. But, yeah, very, very...
Which may give you a clue as to which side Austin lies on.
Yeah. We'll see. We'll talk about that. And then the last one, missed opportunities hurt the player approach more as it goes for sometimes very large wins.
Right.
So, kind of regretting, those missed opportunities will really make you upset.
Yeah, the only reason that missed opportunities hurt the player approach more is because when you're going for those very large wins, you obviously have to find a trend at the right time and ride that trend. So if you happen to be, a great example of this is oil. Let's say you were a positional oil trader. ABVV is another great example. But let's say you're a positional oil trader and you saw what was happening in Ukraine, but you were on vacation, so you didn't get into the oil trade that you wanted to get into because you were taking time off from the charts. That would be an example of a missed opportunity on the player approach because you missed that macro trend that was forming, and that's why it hurts a little bit more towards this style.
Yeah, absolutely, because they have the opportunity to snipe that bottom.
Absolutely.
Or the breakout, right?
Yes.
Now it's the house approach.
Yeah, now we're going to move into the house. And, this is seen by a few more I would refer to as institutional traders. If you've ever heard of a market maker position, I would say most market makers fit into the house approach. But it's typically relatively small wins amongst fewer larger losses. But the win rate is much higher on the house approach versus the player approach, obviously, because the player approach has much more losses, smaller losses, but much larger wins when they do incur those wins, right? So examples of the house approach would be scalping, flow trading, arbitrage styles, and long and short strategies, amongst just a few. So for the house approach, flow dynamics, right, how orders move, and internal market knowledge provide huge insight. No stop is used depending on the setup. There is open-ended risk in this style. And again, that's not for everybody, and we will talk about in the next slide, or it might be the one after that, how you can blend these styles together. But the overall picture that we want you guys to get here is which side you lead more on so that you can identify what to do that is more conducive with where you naturally lean. And it also has increasing/decreasing risk in a mean reverting style. So the house approach follows the mindset. This is something that Austin actually says quite a bit. You never go broke taking profits. This is something actually all of us say a lot, right? And this approach favors highly active approaches. As you can tell, scalping is definitely highly active and typically requires highly constant activity, vigilant in the way of threats. In case you run into a resistance level, you may need to cut your trade rather quickly due to you just, in the inherent nature of you scalping. Austin, would you like to take this one?
And I was muted. My apologies. I do that often. I'll start talking, and little do I know I was muted the whole time, so my apologies for that. So both sides do have pros and cons, as we said, right? You can have a blend of both, and there's not always going to be necessarily a right or wrong way to do it, but the essential idea is that neither side is better than the other. And you'll notice, at OBR, we do have a little bit of both personalities here in the server. And you can see here, Logan does lean more towards the house approach in terms of intraday activity, but leans more on the player approach in terms of risk and sizing, right? So Logan is a little blind to both, whereas we see big bull trades. I know you guys are big fans of bull. Bull is definitely on the house approach in terms of activity, and in general is more so than most of the people in the server, right? So bull definitely takes on that house approach mentality to the fullest, I would say at least. And then the last slide that we have here is the best thing I think about this whole entire slideshow. It wraps everything together and gives you a great visual as to what we're talking about. Because if you haven't visualized this yet, it might be kind of hard in your head to know what we're saying, but this slide should help a lot, right? See the player approach, many big wins, but few big wins, but many small losses, and then that's the player approach. And then the house approach, right? You have those big losses, but you have many consistent W's, right? So it's just two different styles of trading, but if we look at both of them side by side, they do end up with similar profit margins, right? So it's not necessarily that one is bad or worse. They're just two different styles, two different personalities,
right?
Trading the market,
right. And I think this is worth breaking down a little bit more. And after we do break it down, Austin, I'd love to hear where you kind of think you fit in terms of the player, the house approach, because I know you take from both sides, so I'm curious to hear your opinion. But yeah, so this is pretty much a diagram that shows, the wins are obviously W's, L's are losses, and as you can see on both sides, we have many wins here that are larger, followed by some break-even trades and a lot of losses. So somebody that I would say that fits more into this aspect of trading would be Clayton's active trading style, right? Clayton has a lot of losses, but when he wins, his risk to reward is on average 5 to 10. So his one win is worth 5 losses. And then as you can see here, obviously you would want to blend both sides so you're not incurring these big L's that are shown here, but sometimes that does happen with the house approach. So there's a lot, heavily outweighing with wins here, some break-even trades, and then some losses, and some of them are bigger. Just a few are bigger than the other ones. But as you can see here, it breaks it down, the math of each one, how everything is based on a perspective of risk, guys. And this is something that I wanted to highlight with you guys. And, Bull's a great example. Let's compare me and Bull. Let's say Bull is risking, for one of his contracts, one of his trades, he's getting in with a much smaller size because he's willing that the contracts essentially go to zero, right? But for me, on the other hand, I have a set risk limit on my trade. So I can risk more on my contract value because I am not going to lose as much. Or at the same time, we're going to lose the same amount. Let's say if I lose 20% of my contract value and he loses 100%. It may be the same risk. That's why it's completely comes down to perspectives of the risk, right? So here it shows, in total, we have 10 wins, 43 losses, and 60 trades total in the player approach, with a 23R profit. That's risk to reward. In the house approach, we have a lot more trades, right? From 60 to 136, 109 losses, 109 wins rather, 15 losses, so much more wins than losses. But as you can see, the same profit comes out on both sides. So this just comes back to the fact that neither side is necessarily better. And, like we said again, you can pull from both sides. But the idea of this exercise and the idea of these principles is that you can see where you naturally lean more, so you can align yourself either more with that side, or you can pull from the other side where you think you're lacking. So that was kind of, just this summarized, and, just to highlight this, put it in a little bit more of a visualized manner. But Austin, I'd love to hear where you kind of think you fit in this model.
Yeah, I would say I'm definitely more of a house approach. I do have some player approach in me, but there will be time, like I said, I'm like a little goblin. I love to take my profits. It's worked out for me very well. And, sometimes when I am feeling aggressive on a trade, and, my clearly defined risk level might be a little bit farther away than I would have liked to, I will incur some decent sized losses, whether those be up to 40, 50%, right? But most of my wins, I'm taking 25, 30%, but I am winning a whole lot more than I'm losing. So I would definitely say that my style is more representative of the house approach. But again, depending on the situation and context, some days I can have the personality of a player approach, right? So it all depends, but I would definitely say that I lean more towards the house.
Yeah, I mean, if you look on the player approach, there's no small wins, and you definitely do like to take some small wins sometimes, and there's nothing wrong with that. That just fits you more on that end.
There's many situations, guys. I know everybody's stuck up on, and I know this is whatever, but I know everybody's stuck up on like, oh, I need 50% or I need 40% on this trade. Well, what if your trade doesn't run 40%? Are you just gonna sell it for a 20% loss? Why wouldn't you just sell it if things are starting to look ugly? Why wouldn't you sell it when you're up 7 to 10%? And then look to reposition, right? You won that trade. So I'm a huge fan of taking profits when I see them, especially if, things start to, kind of fall apart. I'm not just going to sit there and hope that I see 40% on my trade, right? But, the player approach would, right? But they'd have a tighter stop loss.
Yes.
So.
Awesome. Well, that was really it for these two. And
so let's just recap. Let's
do it.
About what we started with, right? The trading process, right? The 5 stages of the trading process. If you want to go back and just review those really quickly.
Yeah. So
you
go for
it. Do it or I can do it. Doesn't matter.
Go for it.
Okay. Yeah. So you're going to be sensing and scanning the market, guys. Very important to understand your environment, understand the context, understand everything, what's going on, both fundamentally, technically on the market, right? Then you're going to be, having that awareness of a need, right? You're looking at the market, you're looking to find a trade. Once you sort of find that, that zone, that trade that you're looking for, you're going to have sense making. You're going to be planning for action. You're going to be kind of getting your plan, getting your strategy for the trade, what you think is going to happen, what's your stop loss, what pattern am I recognizing, all that good stuff. Once that is all recognized, you will then move to the action, execute the trade, and actually enter with your money, right? You have your trade entry, your trade exit. Very good. Whether you won or lost, regardless, right? You made the trade. Then you have your need fulfilled. After that, you need to have the closure. You need to let go and move on to the next one. Look for the next trade. Restart the process over and over again. After that, what else did we talk about other than the trading process? We talked about the 2 types of traders that you might be, right? The 2 trading approaches, both the player and the house. Those both have their own 2 different personalities. We want to go down to the last slide, Logan. We can go ahead and visualize those real quick one more time. And there it is. The player approach filled with many, many large wins. Wins with many, many losses, but the wins definitely outweigh the losses in terms of size, right? On the house approach, it's quite different, right? Many, many more trades, more wins, more break-even trades, but the losses are much larger, right? But all in all, they typically will share the same profit margins. So it's all about today's, essentially today's bi-weekly call, trading psychology, understanding the trading process, understanding what goes into that, and kind of understanding what kind of trader you are. Okay, so I hope that helped everybody today. I know it helped me. I know it helped Logan. Logan has been talking about this to me for like weeks now about how important it is to understand this stuff. And when you do finally understand what kind of trader you are, you might be able to make some critiques and some changes that you otherwise wouldn't have recognized. So I hope everybody got value out of today's call.
We're not done yet.
No,
We're not done yet.
oh, we're not done yet. Sorry.
We still got to get to part 3.
What's part 3?
Part 3 is the Kaizen mentality.
The part of Kaizen mentality.
So
Well, I was looking at the slideshow.
yeah. This part is not on the slideshow. This part I figured we could just have a friendly conversation about. But for anybody that's not familiar with the topic of Kaizen, Kaizen was introduced first in the 1940s by the Japanese. To my knowledge, history like that might be blurred. Maybe I'm wrong. But to my knowledge, it is from the 1940s in regards to the Japanese when they were building tanks or trucks for the war. And it was the idea of daily constant improvement, small incremental improvement every single day. So I wanted to just quickly talk with you guys. I'm going to stop sharing my screen now. About some things that can help you in regards to daily incremental improvement in your trading. So Austin, I really do want to get your thoughts on this before I dive into mine.
On the Kaizen?
Yes. What are some things you do on a daily basis to improve incrementally?
Well, I'm always trying to adjust my trading strategy, trying to find things that whenever I take a trade, right, I'm always trying to break apart what I did wrong and what I did right. And I definitely take away from that, and I try to, keep the good stuff that I did and try to maintain that into the future, and then I try to, get rid of the bad stuff. So I essentially, every trade I take, I learn a lot from it, and that helps me grow.
Yeah.
Mentally.
Yeah, and this is something that I feel like I've said quite a bit, and I feel like maybe not everybody's tried it yet, but if you haven't, I highly encourage you to do it, and this is journaling. So a lot of people push journaling off to the side, and I was also a victim of that. But I'm telling you right now that my trading results exponentially improved when I took my journaling seriously, because when you journal, you can really take what Austin's saying and put it down on paper and identify what you did right and what you did wrong. A couple of days ago, I shared one of my daily report cards that I do every single day on every single trade that I make. In that, I go over, was it a long signal? What was the symbol? What was the result? I go over my entry, my exit, and what could have been better. What was my evaluation of the trade? If nobody's doing that, I highly, highly recommend to do that. You don't necessarily need to keep a trade journal. I know some people don't like to do that. I do, just because I share it with you guys at the end of every week. But more importantly, dissect your trades. Because if you're going into this market and you are just trading and not taking a step back to see what you did right or what you did wrong, the Albert Einstein quote, insanity is doing the same thing expecting a different result, right? So if you can't, if you can't dissect and really understand what you did wrong or what you did good and you want to replicate, you're never going to improve. You need to put these things down on paper. You need to really spend some time and identify your weaknesses and your strengths so you can improve on them. And one of the ones, just to bring it into a real example, one of the ones I've been focusing on a lot recently in this last month was holding onto my winners longer. I can say, especially after this last week, I have seen myself dramatically improve as to where I used to be falling shorter in that area. So I highly recommend that, guys. And if you have any questions in regards to journaling, I'm more than happy to go over those. But I highly recommend doing that. That's probably my best practice of Kaizen daily for my trading. Is that what else? There's obviously a lot of other things you can do, but I think the journaling is the main one. Markups, back testing, those are some other examples.
Communications with other people.
For sure.
Having other people break down your trades and talk about it with you. I think that you do a lot of that every day, right? Always in the live calls, we're discussing, we're chopping it up. That's huge.
Absolutely.
Being in a community while you trade, right? Learn from that.
100%. I've learned a lot from just talking to Austin.
Oh yeah.
So
vice versa, right? Everybody. You learn a little bit from everybody.
Absolutely. I've learned a lot from talking to Kickstand.
What's that?
I was just making an example. I learned a lot talking to Kickstand, one of the members in here.
Yeah, absolutely. So, are we ready for questions?
We are ready for questions.
Cool.
I just definitely wanted to touch on that.
Yeah, no, I think that's very, very important.
I got a question.
Let's go.
All right, awesome. Well, first, thanks for doing this. That was really informative. Definitely going to take you up on the Dream Journal, Trading Journal.
Yeah.
That's actually a really good idea that I think I need to do. It's going to help me identify what I'm doing wrong, what I need to improve on. So talking about I was interested in the sizing subject. So when you find a trade that you're really excited about, what are the factors that make you go heavy into it? Like, what do you see in it? Like, I know me and Logan, we've talked about 15-minute candle crosses past resistance or past a certain trend line. What are some factors, or what do you need to see for you to be super confident into a trade and to go super heavy into it?
Confluences, my friend. Confluences.
Okay.
Logan, do you want to talk about Apple the other day?
It's so funny that you're saying that.
That was a great. That was a great trade. I'm kind of interested in what you saw that made you want to go or be super confident in that trade.
Yeah, so I'm actually putting my Apple report card in chat right now. So this is, also an example of my journaling that I do, just one of the journals that I have. And this was the Apple trade. But, I think that the answer to your question is completely dependent on your entry parameters. So I come from a background of very mechanical trading strategies, so I'm very familiar with the concept of checklists. And, when I went through my checklist on Apple, which if you download it, you'll see it, it ticked off every single thing that I look for in terms of a technical setup. So when I see something like that, like checklists are a great tool that you can use, just writing down what are you looking for exactly, because you can gauge your trade, grade really on that. So if you're going to get an A setup, that'll be when everything on your checklist is ticked. If you want to get a B setup, that's when, for example, 4 out of 5 things on your setup or your checklist are checked off. So I think that would help you. Get a checklist, identify everything you're looking for so that you can properly grade your setups, and then you'll be able to identify what is an A-plus trade, and when I see an A-plus trade, how much am I then willing to risk on an A-plus trade?
Right. The more confluences you have pointing a certain direction, right, try to be, as objective as possible, don't be biased in your confluences, but the more confluences you have pointing towards something, ideally you'd like to be more confident in that trade, so
exactly
put a heavier weight, more capital into it. So confluences are very important. There's actually a point in time where me and Logan were trading, and we actually required 4 confluences to take a trade. Now this can be both beneficial and bad if you don't do it properly, but typically the more confluences you have, the higher probability the trade would be.
Awesome. So I see it says break of upper ORB. I see you talk about ORB a lot. Is that an indicator that it's on every platform, or is that?
It's not an indicator.
It's more of a concept.
It's a level on a chart, right? You don't need an indicator to apply it. It is simply the opening range of the day. So ready there. You have a 5-minute candle, right? 5-minute chart, a 15-minute chart, 30-minute chart, right? You have all these time frame charts where one candle represents that time frame. Typically, we like to view the 15-minute and the 5-minute for day trading. And especially for the open range, we're looking at 15-minute. And essentially, all we're doing is seeing the high and the low of the first candle printed on that day, specifically for the 15-minute candle. But you could look at the opening range for any time frame. It's the first candle printed of that day and the high and the low. Right, and then you draw a horizontal line from the high and the low, the wicks, like the very high and the very low, and then that will be your opening range, right? So for example, the 15-minute opening range, right, we're going to take the high and the low of the first 15-minute candle of the day.
Including wick.
And you can you can draw that out on each ticker you want to begin the day, and that's your range, and if it breaks below that, that's a confluence. And if it breaks
above confluence.
That's another confluence. Okay.
You want to see closes below that, right? It is so Logan, how unbelievable is it?
It is. It is unbelievable.
Well, right, it's like a 60-something% win rate, but that's if you're using it by itself. That win rate will drastically go up with other added confluences, right? Because you're not just using your open range, right? You're using many other things as well.
When you say you're looking at the 15-minute chart, you're waiting for a 15-minute candle close above.
Yes.
The top range.
Yes.
Above or below the top range. Okay.
Yep.
And if you are a little bit more lazy, or you just necessarily don't want to draw it every day, there is an indicator on TradingView. The one I personally use is ORB by 15-minute by Equity Durai. I know there's an ORB current time frame. Ben,
it's not actually, sorry.
No, I was just going to say, Ben found another one where it actually gives you take profit levels. I've never used those, but you can also find the ORB indicator on ThinkScript as well if you want to use it on TOS.
Yeah, I just want to make sure people understand that it is not an indicator. Right? It's not. It's all it is drawing a horizontal line of the first high and low of the first candle of the day. That's all it's doing. Nothing more.
Perfect. Here you go, talking about it all the time, and I've always wanted to ask that, but I keep forgetting, but I appreciate it.
Yeah, man. I'm surprised you haven't asked earlier. Jeez.
Yeah.
Throw that into the strategy ASAP, man. ASAP.
Exactly. Yeah, it seems pretty important because you guys talk about it all the time. So I wanted to make sure I knew what it was.
When we do our live trading every morning, right? Me and Logan, our first order of work to acknowledge is
the break of ORB.
Right. How are we going to interact with our open range? That's like the first and only thing that we're acknowledging right away in the morning.
Yeah.
Right. That's why typically you will not see Logan or myself or many other people, for that matter, enter a trade until 9:45.
At least.
At the earliest, yeah.
Yeah, and just to put that in context, ORB is very, very useful for day traders. It's not going to be as useful for swing traders.
It's going to be irrelevant for swing traders, actually. Completely irrelevant, right? Because the ORB strategy is completely reliant on intraday moves. Right? So the open range doesn't work with like a daily chart.
On Monday, I'm gonna start before when the market opens, draw some ranges and practice that.
Absolutely. Yeah,
cool.
Or just throw it. Like I said, there's scripts for it that it'll apply it automatically.
Yeah, I need to get TradingView. I'm still stuck on Webull.
Well, TradingView is free, my friend. Hop on.
Is it free? Is it only like one chart at a time? Or you can do like multiple charts. I thought it was.
If you're unless you're like me or Logan, like really just using a bunch of shit and like just really using the platform to its fullest. I was on free TradingView for a year and didn't like I could be on free TradingView right now and I would be fine.
Okay.
So yeah, there's no barrier to entry when it comes to analysis.
Awesome, I appreciate it.
Absolutely.
You're helpful.
Anybody else have any other questions that we can address? Maybe
we
happy
do
to do so.
Quite a couple muted people in here, so if you are muted and would like to be unmuted, please let us know.
Yeah. And we understand that it is Saturday, or Friday. My days are messed up, right? Give me a break. Friday. It is Friday afternoon. The market is closed. It is a really nice day out over here in Massachusetts. I'm not sure how nice it is over
Beautiful.
by you, Logan.
Oh, it's gorgeous out today. I think it's like 86.
Wow. Holy cow. Yeah, it's, let's see the weather here. 59. Pretty warm out.
Can you believe how many times I couldn't say the word psychological in that quote earlier?
Yeah, that was horrible. I was embarrassed.
It was like an easy word to say, too.
I'm kidding. All right, guys. Yeah, so if nobody else has anything, we appreciate your time today. We hope to see you, Monday for Market Open. We'll be right in the live trading call, and we'll be hopefully hitting some bangers there for you. But I hope you actually learned something today and you took something away from it and you're able to apply this stuff into your everyday trading. So, yeah, that's all I got. Logan, you got anything else before we wrap it up?
No, if nobody has any other questions.
Cool.
I want everybody to enjoy their, hopefully, day off.
Yes. I know I'm going to go be playing, I'm going to play 18 holes here shortly, so.
Nice. I do see Dreaded Super is typing, so I want to give him a chance to get his
The
message
rough
out.
life of a trader.
Hey, Wall Street, they like their Christian holidays, man, so.
Yeah.
I
Speaking
gotta
of...
take advantage of them and go golfing.
Absolutely. Speaking of that, I hope everybody has a fantastic Easter weekend. And Passover.
Yes. Dreaded Supra. A great way to get around that, and you have to be a manual nerd like me, is whenever I wanted to use a different indicator, I would just delete one and just add a different one. So,
you can do that. Another little hack I'm going to give you is if you're using free TradingView and you need more indicators, this will only work one time, but you can get the free trial, and you can add the indicators you need. When the trial ends, it won't remove the indicators from your chart, but if you do remove them, you won't be able to add them back.
Ooh, nice.
Don't tell TradingView I said that, but
yeah, don't do that.
Email me right now.
Cool. All right, guys.
All right, guys. Everybody take it easy. Hope you enjoyed today.
Cool. Catch you guys later.